My name is Jon Hall. I'm an external member of the Bank of England's Financial Policy Committee. And I'm very happy to be here with you today at NISA. And over the course of the next 40 minutes, I'd like to discuss the dynamic nature of leverage and the tension between deleveraging behavior and financial stability. I'll illustrate my points with reference to the leveraged LDI structures that amplified the market shock of autumn 2022. And in particular, I'll argue that when asset prices decline, a leveraged investor only has three alternatives. Either they can dynamically deleverage their position by selling assets into a declining market. They can temporarily accept higher leverage, but that risks what I'll call cliff edge deleveraging if prices fall further. Or they can deleverage by raising capital. I'll analyze in detail the first two alternatives and how they increase financial stability risks, particularly in the event of a negative price shock like we saw in autumn 22. This analysis applies to any strategy which results in an investor selling assets into a declining market. Alternative 3, to recapitalize, is therefore the most preferable from a financial stability perspective, but only if the investors take seriously their responsibility to have the liquid assets, the operational capabilities necessary to meet any capital calls. I'll then detail our recommendations in response to the events of late 22 and highlight the importance of our ongoing work, including the recently announced System Wide Exploratory Scenario. After that, I look forward to discussing your thoughts and questions. It might be helpful if I begin with a specific example. Imagine that you're a small pension fund. After reviewing your liabilities to your pension holders, you determine that you have an exposure to interest rates and inflation that is equivalent to 200 of a portfolio of long-dated nominal and inflation-linked UK government bonds. Henceforth, I'll talk about this as a gilt portfolio, and that should be understood to capture both nominal and inflation rate linked bonds. The net present value of your exposure increases as gilt yields fall. And you want to reduce the risk of your fund with respect to interest rates. So in order to do so, you need to buy 200 gilts. But unfortunately, you have only 150 of funds at your disposal. Although your corporate sponsor does understand that they're obliged to cover the ultimate funding gap shortfall, they are not able to provide cash today. A consultant suggests the pooled LDI structure run by a well-known manager. The structure is set up to borrow 50% of the market value of any gilts owned. Therefore, an investment of 100 will enable a purchase of the 200 bonds you need to hedge your liabilities. This is a structure with 2 times leverage. The consultant explains that because gilts are high-quality assets, borrowing only 50% against your holding is low cost and gives you a significant buffer even if prices fall. With the remaining 50, you can invest in a range of assets that should on average return more than the risk-free rate available on gilts. If successful, this excess return will close the funding gap over time. And this is supposed to be an illustration of how you're reducing the volatility and closing the gap over time, so that in the end, your target is that you have a fully funded pension scheme. And this obviously reduces the obligation on the corporate sponsor. So having got this advice and understood the structure, you enter into it. And from then on, your focus is mainly on the purchased other assets. You receive an update on their performance and the state of the funding gap at your regular meetings. And you make sure that the corporate sponsor is aware that if the assets do not perform well, they may need to inject further capital over time. On the surface, this process seems sufficient, but it is missing a crucial element. In the scenario, you're not paying enough attention to the dynamic nature of the leverage that you've taken on, and to ensuring that you have the capability, both financial and operation, to meet any capital calls. Adverse moves in the underlying gilts will lead to an increase in leverage, and that can only be reduced through asset sales or through an injection of capital. If a capital call is made by the LDI manager but not met, then the gilt portfolio will start to be unwound. And if that's allowed to happen, what was intended to be a permanent volatility reducing hedge was in fact a temporary and leveraged bet unwound at unattractive levels. This scenario illustrates a number of facts about pension fund LDI investments in 2022. First, pension funds invested in these long-dated interest rate and inflation products as a hedge. It's been said before, but it is worth reiterating that pension funds generally benefit from a rise in gilt yields. The declining gilt prices and the rise in yields in 22 had a positive impact on aggregate funding ratios as the value of liabilities fell. Asset prices did fall, but they fell by less than the value of the liabilities. Second, many pension funds engaged in leverage, but they did so that they could hedge their liabilities despite not having a fully funded scheme. This allowed the pension fund and corporate sponsor to close the funding gap over time as a function of the higher return on risky assets, or perhaps through an ongoing program of cash injections from the corporate. Leverage in pension fund investments did not cause a solvency problem, but it did cause a liquidity problem. Finally, a significant source of amplification of the market shock in late 22 was smaller pension funds who invested in pooled funds. Although segregated mandates represented a far greater share of the liabilities hedged, investors in these structures generally had relatively sophisticated liquidity management processes, and they performed well in general. The table outlines some of the differences between segregated mandates and multi-investor pooled funds. Some of these differences, such as the limited liability structure and the lack of flexibility, increased the likelihood that gilt hedges held in the pooled structure would be unwound by the LDI manager. It was a combination of large and sudden capital call obligations, liquidity manager actions, and weak liquidity management processes that led to the selling of gilts. This selling amplified the initial shock and threatened to spill over to financial instability. Investing in a leveraged product can bring benefits, but it also brings dynamic responsibilities. And if an entity is not set up to meet those responsibilities, then the leveraged investment is unsuitable. It is often said that leverage is dangerous because the size of loss is not limited to the size of the initial investment. In the earlier example, if the value of bonds goes to 0, then the loss is 200, even though the original investment was only 100. This loss is a function of the performance of the assets. But it's important to understand that there are two other potential sources of risk. These relate to management of the borrowing and to management of changes in leverage. These three sources of risk can be represented in the form of a triangle, as shown here. Turning first to asset performance, some investors might feel that the downside of the asset performance can be mitigated by investing via a limited liability structure, for example. In that case, exposure is limited to the initial investment, and even if the bonds go to 0, there's no recourse to the investor's other assets. However, this does create another risk, that if losses exceed the initial investment, the position will be unwound by the manager or by the leverage provider. The pension fund investor considered in the previous section might receive further comfort from the fact that although the LDI structure is leveraged, the asset exposure is sized to hedge the liabilities. With respect to the loan management side of things, if borrowing is not locked in for the entire life of the trade, then it is subject to what is called rollover risk. When the initial borrowing comes to an end, it must be replaced. And there is a risk that lending terms might have worsened, that the new borrowing rate might be higher, or the amount of cash offered lower. At the extreme, lenders may be unwilling or unable to lend, in which case recapitalization will be necessary in order to avoid a forced unwind. However, if borrowing is collateralized by a high quality asset, such as a UK government bond, this will minimize any rollover risk. A leveraged investor in gilts might feel relaxed about the loan management risk. An LDI investor may therefore feel that the general warning with respect to leveraged products does not apply, because their assets are held as a hedge, Their losses are limited to the size of their investment, and their rollover risk is minimal. Unfortunately, this benign view doesn't take into account the third performance driver, the management of dynamic leverage. If asset values decline, then leverage will increase, and a choice must be made. They must either rebalance the portfolio through dynamic deleveraging, accept higher leverage and risk cliff edge deleveraging later, or raise capital. This triangle is what I'll focus on today, discussing the impact of each of these possibilities in turn. When investments are marketed as having a certain leverage, one might assume that this is a naturally static number, but this ignores a feature of leverage that is not widely discussed in the popular press, its dynamic nature. A constant leverage can only be maintained by actively rebalancing the portfolio as prices move. This leverage targeting behavior is necessary to offset leverage's natural dynamism. For example, if we return to the original 2x leverage bond structure discussed earlier, it can be seen here that changes in the market value of the gilts lead directly to changes in leverage. As displayed in this graph, if the bond prices rally from 100 to 125 and no other actions are taken, then the leverage declines from 2x to 1.67x. Equally, but more concerningly, if bond values decline to 75, then leverage increases from 2x to 3x. To offset any increase in leverage and any risk that they themselves might take a loss, the manager of a leverage structure could sell or force the client to sell some gilts. For example, if following a 25% price fall, they sold 50 of bonds and used the proceeds to pay off the borrowing, then the leverage would decline back to 2x. Although this action is consistent with the maintenance of a static leverage profile, it has two concerning implications. First, from the investor's perspective, this means that the structure will automatically reduce the size of the positions when there's a loss. This automatic sell low and buy high leverage targeting behavior not only has a negative expected value in a volatile environment, but it also removes the investor's control with respect to sizing. If, as was the case in LDI, the position is entered into as a long-term hedge against liabilities, then anything that unwinds that hedge is increasing the overall risk of the pension fund. Second, from the perspective of market stability, this dynamic leverage targeting behavior is an automatic amplifier of any price moves. A foundational principle of economics is that the pricing mechanism balances supply and demand, and this relies on the assumption that, other things equal, demand for a product increases and supply decreases as its price declines. Given a set of information and economic actors, the market mechanism ensures a stable equilibrium price is found. If there's a shock or new information, then in an efficient market, the price mechanism responds and a new stable equilibrium is found. This graph shows a sort of model of stabilizing flows. It's a stylized example where supply and demand are both linear functions of the difference between the fair market price, which is 0 here, and the actual price. Note that the y-axis displays the volume of what I'm calling stabilizing activity. If the price is below fair value, then positive stabilizing activity is net buying. If it's above fair value, positive stabilizing activity is net selling. The further the price from fair value, the greater the volume of stabilizing activity. You can imagine the price as a ball falling from above. Wherever it falls, supply and demand will push it towards fair value. This creates a stable equilibrium around the fair value price. Such natural stabilizing activity towards fair value is a common good. It allows buyers and sellers to exchange goods at a fair level and provides valuable information which can be incorporated into economic decisions. However, this efficient pricing mechanism is undermined to a greater or lesser extent by investors that target a fixed leverage. Every time the price moves lower, they add selling pressure. in direct contrast to the assumption underlying market theory. If the aggregate size of deleveraging is great enough, then any price level becomes unstable. Any displacement will be amplified, such that prices move further away from a fair level, and the informational content of the market price will fall to zero. Dynamic leverage targeting behavior is destabilizing. It depletes supply of a common good. As can be seen here, the destabilizing activity of leverage targeting is nonlinear. It's greatest when there's a large fall in price. This is due to the exponential distribution of leverage that I showed you before. If the metaphorical ball of price action falls on this profile, deleveraging activity pushes prices away from fair value. This graph shows the aggregate flow of this stylized example, summing the previous two graphs. In times when market moves are small, deleveraging volumes will be small in the context of market liquidity. The selling will be absorbed within the normal market flow, and although market stability might be reduced, the reduction will not be enough to be problematic or perhaps even noticeable. This describes the market reaction to price falls that are smaller than 20% in the graph shown. For larger price falls, however, the volume of selling overwhelms the buying. Deleveraging activity flattens aggregate demand for the asset as prices decline, and it inverts it if the move is extreme enough. Although the specific size of flows in this stylized example were picked at random, the resulting profile does seem to capture a feature of the market that I've previously described as jump to illiquidity. In normal times, when moves are small, the market appears stable. But in large shocks, instability strikes. This is the exact market dynamic that was seen in the dash for cash in 2020 and in commodity markets after the Russian invasion of Ukraine. Market stability is harmed even further if a shock shifts fair value and increases uncertainty, as happened in the autumn of 22. This has three consequences that amplify moves. First, the shift in fair value means that there'll be no buying to offset the deleveraging flows until beyond the new fair price. Second, increased uncertainty and volatility cause a reduction in market liquidity as market makers assume a defensive posture. This reduces the demand, which could potentially serve to offset the increased supply. And finally, if the shock is large enough, it will take the market into a zone where the deleveraging flows are significant. If a leverage position is large, or if there are multiple correlated leverage positions, then these flows will push the market down further, causing an avalanche of selling. In the graphs, I've assumed a 0.1 shift in fair value and have represented uncertainty by reducing the slope of the stabilizing V to 75% of the original. This reflects the reduced confidence of liquidity providers. Leverage targeting activity is unchanged, as it's purely a function of the price move since the last rebalancing action. And this shows the sum of those actions, which means that the market isn't even stable around the new fair value. As can be seen, when a shock decreases fair value and increases uncertainty, and when it hits a market that is subject to significant volumes of leverage targeting behavior, destabilizing activity can amplify moves and push prices significantly away from fair value. Eventually, of course, the deleveraging will be complete, or what Darrell Duffy has called slow-moving capital from inattentive investors will arrive to take advantage of the price dislocation. In advance of this reversion, however, significant harm may have been done to market and financial stability. Although today's discussion focuses mainly on the financial stability risks of leveraged LDI structures, the concerns expressed with respect to deleveraging behavior can be applied much more broadly to any market participant whose strategy results in selling as the market declines. This includes any funds who enter into trades to take advantage of market mispricing, but are then forced, due to internal risk limits, margin calls, or a loss of financing, to unwind as the mispricing grows larger. The FPC in its communications often talks of amplification. In this context, amplification can be seen in direct opposition to the stabilizing effects of the market pricing mechanism. Deleveraging behavior may seem prudent from the perspective of an individual fund, but it depletes a common good and undermines a fundamental source of market stability. In biology, global trade, and markets, efficiency in good times often comes at the cost of a reduction of resilience in bad times. Although leveraged or minimally capitalized investors will often state that their actions enhance efficiency in good times, what is also important from a financial stability perspective is how they behave in periods of stress. The FPC very specifically seeks to ensure that the financial system serves households and businesses in bad times as well as good. Deleveraging behavior and stress undermines our ability to meet this objective. As an alternative to dynamic leverage targeting behavior associated with portfolio rebalancing, investors, managers, or lenders might feel that the quantum of leverage is irrelevant and should be allowed to rise. In this case, the portfolio is left unchanged as long as there's enough collateral to cover the borrowing. From an LDI investor's perspective, this would make sense. The gilts owned are calculated to match liabilities, and this means that not only does the investor wish to retain the hedge for as long as their liabilities exist, but also from the point of view of asset returns, the fact that the structure is leveraged is irrelevant. The pension fund needs 200 of exposure to hedge their liabilities, and the dynamic nature of leverage does not impact that fact. From the lender's perspective, as gilts are considered to be extremely safe assets, the over-collateralization required will be minimal or maybe even non-existent. For a loan of 150 gilts is more than enough. It is only if the value of the gilts falls to 100 or below that the lender will be exposed to the credit risk of their counterparty. And finally, the LDI manager could also agree, because they are protected by the right to unwind the structure before the loss exceeds the size of the pension fund investment. The problem with this willingness to accept higher leverage is that it creates what I've called a cliff edge effect. In the short term, no action will be taken, but if the value of the gilts falls far enough, then there is a risk that their value is no longer sufficient to collateralize the borrowing. In advance of the transition from over to under collateralization, the LDI manager or the repo provider will close out the position to protect themselves. Thus, the ongoing rebalancing associated with leverage targeting has been replaced by a potential sudden sale with the entire position unwound in one go. And although this might seem an unlikely scenario when the investment is initially made, the consequences, if we get to that situation, are significant. The cliff edge point, the investor will have lost both their initial investment and their hedge. As well as being a negative outcome for the investor, this can also cause financial stability risks. If the investor's full position is sold all at once and as a matter of urgency, this will drive prices lower still. This may push other structures into deleveraging behavior, causing more selling. In addition to the direct market stability implications, a decline in the value of collateral could leave repo lenders having significant losses on what was supposed to be almost riskless lending. I'm reminded here of a quote from free climber Alex Hanold as he was discussing the possibility of falling 900 meters from El Capitan. He described falling as low risk, but very high consequence. In autumn 22, what was perceived to be low risk became a central scenario. As you can see here, long-dated gilts traded at less than 50% of their Jan 22 value, and inflation-linked gilts traded much less than. Although I've taken pains to elucidate the differences between leverage targeting and cliff edge deleveraging, in autumn 22, these differences became moot. Either strategy would have caused significant selling, amplifying the shock and harming financial stability. The final element of the leverage portfolio management triangle is by far the most attractive from the perspective of hedge maintenance and of financial stability. In this scenario, rather than responding to a decrease in prices by selling gilts, the investor reduces leverage by recapitalizing the structure. For example, if the structure is set up such that for every move lower in gilt prices, 50% of the loss must be replaced by new capital, then this cash injection can be used to pay off some of the borrowing and reduce the leverage back to 2 times. One implication of such a capital call is that it increases the investor's total exposure. They're now exposed to the initial 100 and the subsequent cash injection. Their exposure is greater than the original 100 despite the limited liability structure. At the extreme, if this process is repeated as the value of the bonds decline to 0, then the investor does run the risk of losing the full 200. However, if the investment is a hedge, as in the case of LDI structures, then this loss will be offset by a reduction in their liabilities, so the pension fund overall will not be harmed. Meeting the capital call in structures such as the above must be taken seriously by trustees. When trustees sign off on a leveraged LDI structure as a hedge to their liabilities, they need to understand the dynamic nature of the obligation. It is not enough to receive advice from a consultant about the suitability of the hedge, nor is it enough to ensure that the LDI provider is credible. These are static issues that are necessary but not sufficient to ensure that the leveraged investment is appropriate. What trustees and sponsors must understand is that if a capital call is made, then they need to be able to meet the call. If they do not, then the structure will be partially or fully unwound. This would turn the LDI investment from a structural hedge into at best a contingent hedge which only exists in certain states of the market, or at worst, a leverage bet on gilt prices. Capital calls must be met not only in normal market conditions, but also in times of stress. When the size of the call is large and the timing is urgent, and trustees must therefore have a clear and ongoing understanding of the liquidity of their non-LDI assets and have in place a liquidity waterfall plan which sets out the order in which assets will be sold. This plan must include operational elements to ensure that calls can be met in a timely manner, in practice as well as in theory. And here it's worth noting that often a first source of liquidity is money market funds. And so it's an important part of the FPC's work to ensure that money market funds are able to provide liquidity when it's drawn on, which is often in the case of stress. Now, LDI funds have always had cash buffers to ensure that short-term liquidity needs can be met. And these are usually calibrated based on a historic shock taking place over a number of days. But that incorporates 2 assumptions. The first is that future shocks will be of an order of magnitude similar to historic shocks. And the second is that pension funds and LDI managers have the operational capability to replenish liquidity buffers at pace during periods of stress. Unfortunately, in September 22, neither of these assumptions turned out to be correct. Measured over a 4-day period, the increase in gilt yields was more than twice as large as the largest move since 2000. This meant that cash buffers were overwhelmed and they needed to be replenished immediately in order to avoid asset sales. Some pension funds were unable to recapitalize at the necessary speed, and this led to LDI structures being unwound. As well as being bad for the pension fund investor, this also had a negative impact on market stability. When the other market participants understood that not only would future issuance likely increase, but also that pension funds with huge holdings were becoming forced sellers, the incentive to purchase became minimal. Flows functionally became one way, and the market became highly unstable. On the 28th of September, the Bank of England announced that it would conduct purchase operations each business day until the 14th of October. As John Cunliffe set out in his letter to the Treasury Select Committee, the duration of the operation was intended to give the LDI funds time to build the necessary resilience. By providing market stability through a temporary and targeted intervention, the bank effectively gave the pension funds a window in which to raise liquidity. And many funds did so, and they were therefore able to maintain their hedges. But even with a 13-day window of intervention, this was not enough for some funds. As can be seen in this graph, there was significant selling of gilts on the final day of the program. Now, obviously, the funds selling on that day, they hadn't lost their need for a hedge, nor was the level an attractive opportunity to unwind. They were selling purely because despite the extended period of stability provided by the Bank of England, those pension funds did not have the liquidity or the operational capability to deliver the necessary capital. Or in some cases, because the LDI funds did not have the operational capability to receive such capital. As such, pension funds lost their hedge and thereby increased the riskiness of their portfolio. Although market participants should self-insure against severe but plausible moves, the price declines in those 4 days of September were of an unprecedented speed and scale. Therefore, in my opinion, the inability of some pension funds to raise capital in advance of the Bank of England's intervention was understandable. However, the fact that funds could not recapitalize over the course of a 13-day period in which markets were stable reveals a level of understanding, liquidity planning, and operational capability that was inadequate. Pension funds that were unable to raise capital over that period should consider whether holding leveraged investment was appropriate for them. Many pension funds, particularly those investing in pooled LDI structures, were small and minimally resourced, but that's not an excuse. If for whatever reason, raising capital takes greater than 13 days, then the liquidity buffer needs to be calculated with that as an input. This fact should have been better incorporated into liquidity planning. An analysis and understanding of the fund's ability to raise capital from the corporate sponsor, if necessary, must feed into the decision as to whether to enter into a leveraged structure in the first place. For those that do not have the capabilities, the product is not suitable. This is something that both the trustees and the consultants must consider when deciding whether a product or hedging strategy is appropriate. Although the FPC does not directly regulate pension funds, we did set out a number of recommendations in our Q1 publications. These reflect the fact that the rise in yields caused for pension funds a liquidity problem rather than a solvency problem. In summary, these stated that funds should be able to withstand severe but plausible stresses in the gilt market. They should be able to meet margin and collateral calls without engaging in asset sales that could trigger feedback loops. And they need to improve their operational processes to meet margin and collateral calls swiftly when needed. More specifically, the FPC judged that LDI funds should be resilient to a yield shock of around 250 basis points at a minimum, in addition to the resilience required to manage other risks than day-to-day movements in yields. Pension schemes using leveraged LDI should be expected to be able to deliver collateral to their LDI vehicles within 5 days. Funds and schemes unable to implement these operational standards should be required to be resilient to a larger shock, calibrated to their own operational timelines. In addition, we recommended that the pension regulator should have the remit to take into account financial stability considerations on an ongoing basis. Further details are available in the FPC's Q1 publications, as well as a bank staff paper on the subject. Following the bank's intervention in September last year, and the FPC's recommendations in Q1 and TPR guidance, LDI funds have maintained higher levels of resilience. However, recent moves in gilt yields have been significant. The benchmark 30-year index-linked gilt yield rose by 82 bips between the end of March and late May. This is the first test of the resilience standard, and it demonstrated the FPC's recommendations are functioning broadly as intended. Funds are holding significantly larger buffers on average, and firms are initiating recapitalization at far higher levels of resilience. However, we'll continue to monitor the situation and assess whether there are any lessons to be learned from this recent experience. Coming to the end. So today I've mainly focused on leveraged LDI structures, but the findings can be applied broadly. I'll conclude with some more general and forward-looking thoughts. First, leverage has an intrinsically dynamic nature. A decline in asset values causes an increase in leverage, and that does need to be managed. Depending on the restrictions inherent in their mandates, managers of leveraged portfolios may be willing to accept higher leverage in the short term, but eventually they'll need to sell assets or raise capital. From a stability perspective, the preferred solution is for investors to deleverage through recapitalization. For this reason, it is important to ensure that critical sources of liquidity, such as money market funds, are able to supply that liquidity, even in times of stress. In leverage structures without the ability to raise capital at speed, both dynamic and cliff edge deleveraging does create vulnerabilities. These amplify external shocks and deplete the stabilizing forces that are a common good. This is one reason that the FPC has warned that in the event of future shocks, impaired liquidity conditions could be amplified by the vulnerabilities in the system of market-based finance. With our global partners, we'll continue to work to understand and reduce those risks where possible. Alongside the international work agenda, the bank will continue undertaking domestic work to reduce vulnerabilities where it is effective and practical. In December last year, we announced that we were planning a system-wide exploratory exercise to support this work, which would, for the first time, incorporate the behavior and impacts of non-bank financial institutions. I'm excited to confirm that just yesterday, we launched this exercise publicly. An exercise of this type, with its huge system-wide scope, has never been attempted before. It's a multi-round exercise with two objectives. First, to enhance our understanding of the risks to and from MBFIs and the behavior of MBFIs and banks in stress, including what drives that behavior. And second, to investigate how these behaviors and market dynamics can amplify shocks in markets and potentially bring about risks to UK financial stability. We expect the exercise to offer many lessons for us, for participating firms and their regulators, for market participants, and also for the wider international policy and regulatory communities focused on these issues. Risk to financial stability can clearly emanate from non-bank sources, so it's only right that we expand our scenario analysis to supplement our theoretical understanding of these non-linear dynamics. I eagerly anticipate the results of this exercise and expect the insights to influence our thinking going forward. And with that, thank you for your time. I look forward to hearing your thoughts and comments and engaging with any questions you might have.
Well, thank you very much, John, for a very stimulating talk. I'm actually quite excited about this new initiative that came out yesterday to look at NBFIs. We might return to that, but before we do, are there any questions from the floor? I see one right at the back. I see one over here, and one also at the back. I'll take those three in order, going from right to left.
Thank you very much, John. Really impressive exposition of FPC's thinking on the LDI issue and its response at a heightened crisis last autumn, so which we should congratulate you on, I think, in the first instance. But I just wonder if I may be allowed to ask a question as a bit of a hoary old chestnut, just to get your sense on this, and that is the use of the current discount rate to value the present value of liabilities, and the extent to which that in itself was the deeper cause of the problem, because it leads to that gap that you showed early on between liabilities and assets. Now, I know there's a very good answer to this, but I'm wondering what the current thinking of the FPC is on this, whether we should be using something other than the short-term discount rate to value current liabilities, because of course the term structure of liabilities in the pension sector is very long, and it may not make sense to use a short-term interest rate. But I know you'll have a very good answer. Perhaps I could ask you for it.
I'll hold off. We'll take the woman at the back.
Hi, thank you very much. Really interesting chat. Can I just ask, is there any characteristics about the funds that were unable to raise the capital? No, I recognise it's quite early days, but I just wondered if there's any characteristics from those funds. And also, you talked about the common good. How can you get the players to act in that common good? Now, how could you, whether it's some sort of incentive there, but that's the 2 points. Thank you.
Okay, thank you. I'm not doing my job very well as a chair. I should have asked you to give your name and company first. So.
Hi, sorry, my name is Leslie Brennan, and I'm an economist, but I work in Bearing Point as a management consultant. Thank you.
Okay. Sorry. Please.
Thank you. Great presentation. Many thanks. My name is Tim Frost. I'm a a practitioner in leverage. How's that? I'm not trying to be cryptic, but I care about these subjects. Wanted to ask you a little bit about regulation and your thoughts on the impact of regulation on the particular challenges that you were describing there. So, would you accept that an increase in the regulation of cost of capital for market-making books has flattened the gradient of your stabilizing capital? And I wonder to what extent you measured that or thought about that. And I wonder to what extent you think that the changes in regulations impacting pension funds, causing them to have less tolerance for a mismatch in their assets and liabilities, has pushed them towards LDI, and therefore what contributory factor was regulation to the crisis that you described? And if I may, to the extent that you accept that there was some impact there, do you think, with your important role on the FPC at the Bank of England, that more regulation is the logical response to problems caused to some extent by regulation?
Okay, so 3 interesting questions there. What interest rate should we use? How can we get everybody working for the common good? And I'm going to paraphrase really bluntly. Do we have too much regulation? Jon.
Okay, great, thank you. Yeah, and some good questions there. And I think the first and the last question were to some extent sort of linked in terms of the regulation on the pension funds. And so obviously the most important thing to say is that that's not really anything to do with the FPC. So there is the pension regulator, there's the accounting bodies. I mean, you talked about the short-term interest rate, and obviously, so just to clarify, so their long-term liabilities are discounted on the long-term rate, but I guess what's important is, what is that rate? Is it a risk-free rate? How is there some kind of spread for like corporate bonds? Now, it is true that if you look at the total portfolio, assets plus liabilities, and there was that graph, I think, that was supposed to be kind of what a consultant would say, is that your volatility of your total assets plus liabilities is much larger if you don't hedge your interest rate exposure. And of course, we did have this huge sort of 20-year, all of our careers worth bull market, basically, which has just ended. And so, all the way through that, people were saying, well, I shouldn't hedge my liabilities, I'll run the risk, but they were getting less and less funded. And obviously there are sort of some benefits to being fully funded. For example, you might be able to sort of sell the whole pension fund, get that like a sort of professional manage it rather than just a bunch of trustees. So I do think it's a really interesting question about the sort of hedging strategy, but I think there are real benefits associated with understanding that this is a liability. And of course, there can be discussions about how best to discount that. But I think the idea that it should be ignored and shouldn't be discounted at all, I would disagree with that personally. And obviously that's kind of the consensus as well. And as I said, it's certainly not mine or our responsibility to set that. So that's the question there. On the type of pension funds that we're selling, I think I tried to touch on this a little bit when I was talking about the pooled funds versus the segregated funds. And generally, the investors in the pooled funds were small pension funds, a bunch of trustees, they're met fairly irregularly. And the sort of segregated funds were like the big kind of, brand name corporates that you would know. And what's interesting about that is that, and so the segregated would often do derivatives, so do an interest rate swap instead of owning a bunch of gilts, and they would have sort of, derivatives sounds kind of dangerous and obviously has these kind of daily calls, but in a sense, because it was dangerous and because they were, subject to sort of meeting calls on a daily basis of variation, then they had to be very professional about it. And then you go to the smaller pension funds and they're like, well, there's no way we can do that. Plus people probably wouldn't even offer them the ability to do a swap. So we don't have the capability to do that. Give us an easier structure. And so then the pooled fund was set up. But the problem is obviously there's this tension between a fund that's easier for a pension fund to invest in, and the fact that it does have these dynamic obligations. And so then you found that, you know, maybe there was, you know, periods of time when they didn't need to raise capital, but when they really did need to raise it in autumn last year, you know, the operational pipes hadn't been tested. You know, maybe they didn't have a meeting for a week. They had to get everyone together. So there is this tension, which I think is kind of an interesting question about, you know, when you provide a solution to someone to make it easy for them, that shouldn't stop them kind of doing the preparatory works to know when they are kind of required to provide liquidity. And of course, they weren't really required to. You know, they could not provide liquidity, but then they lost their hedge. And so losing their hedge, if we agree that it adds risk, which, you know, some people might, that if we agree that it adds risk and they unwound it at a bad level, it's certainly not at a time that they would have chosen. So the short answer to your question is, it was, if you think about, so I had this metric on there that 85% of their liabilities were in segregated fund, 15% were in pooled. And I don't know the exact number of the breakdown, but it wasn't that. It might have even been the other way around, like, you know, more, let's say maybe 50, I don't know, 50-50 of pooled funds were selling. So there's a lot of small funds rather than the big ones. Common good, actually, so this question and the last one I think come together, which is, there's two elements to this story, and I've only talked about one. So I basically talked about these users of the common good that are depleting the common good, and so you can think about certain business models. Maybe leverage is one that sort of naturally draws from that common good. But there is the other side of the story, which is, well, how do we increase the supply of the common good? And, you know, there's certainly an argument that, well, so I think the one thing I would say is that, you know, to put it in simple terms, is that, you know, dry powder effectively supports the common good. So if you are sitting there with no positions and something moves away from fair value, then you have the ability to sort of say, okay, great, I will take advantage of that opportunity. And that's what, you know, a hedge fund would do. A hedge fund that just set up yesterday, has got loads of capital, has no positions, something moves, you know, away from fair value, they provide liquidity. And there's plenty of liquidity providers, whether they're funds, whether they're market makers, some of them extremely fast money, PTFs, etc. The problem with many of those business models is actually they haven't got the dry powder. They're already running. In fact, a fund of funds would pressure them to be running at kind of max VaR or max leverage. And so then when their position moves against them, what can they do? And in those business models, obviously you can't really raise capital. So you're almost forced to start cutting it. And then you become a destabilizing force rather than a stabilizing force. And Shin has done a sort of, well, he's written a book, so I was going to say a parallel piece of work. It's much more impressive than mine, but about VaR constraints and the stability reducing impacts of being at max VaR and being constrained by that. And so then the question is, in terms of going forward, like, have we, and obviously, you know, so there was a response to the financial crisis, which tried to take risk away from banks, makes a lot of sense, away from retail deposits. In the course of that, have we kind of reduced the amount of dry powder that there is? Because if everyone's at max leverage and they can't raise capital in a short period of time, then they're not going to be there when you need them. And so I think there's, on the one hand, there's the kind of the demand for the sort of the takers of liquidity, but there's another question, which is kind of another speech, which is like, how can we enhance the supply of liquidity? Okay, well, hopefully that's
okay. There's still plenty of time for more questions. I should say, for the benefit of those people online, please feel free to put some questions into the chat, and I will come to you. In the meantime, I'll come back to the room. The people, I see one at the right-hand side of the room, I see one on the left-hand side of the room. Let's go right and left.
Hey, John. My name is Julian. I work for the Bank of England, but this is really a question that's sort of come from, I used to be a derivatives trader. If you own gilts on leverage, it all makes sense. You can work out what your leverage is and how it changes with how the market moves. But if you have a swaps position, how do you, or is there a way that you can get an equivalent leverage number? Because obviously you start on day zero with no cash changing hands, but then it does as market rates move. It's something I've always wondered. I wondered if you have an answer to that.
And on the other side of the room.
Yeah, so I was wondering about, essentially, it seemed as if the crisis just occurred because of the mini budget, but to what extent can we blame pension funds for poor risk management, or potentially a suboptimal level of leverage on their extent?
And one more from Norma.
You've mentioned several times that the Bank of England, of course, doesn't regulate pension funds, and that's absolutely right. On the other hand, we do regulate some of the counterparties in this transaction, and I'm particularly thinking of the insurance companies who were the big sellers of this product. If you look at your description of who was most likely to be in the pooled funds and therefore most vulnerable and most damaged by this exercise, you realize very quickly that these are the kinds of pension funds that are least able to protect themselves in the event of this kind of difficulty. Is there a case, do you think, for better regulation of the sellers of these products? That's an area where presumably the PRA, I guess, or some regulatory constraint where you can limit the boundaries of what these products look like, and they're aggressively selling them. I mean, they make money by selling them, and they're selling them to companies who want to put as little money, as little cash as possible into their pension schemes, and these products allow them to justify that.
Okay, thank you. Three more questions for you, John.
Yeah. So on the leverage of a sort of a swap trade. So I think, yeah, so sort of in economics, I think it's called shadow leverage. And so I think it has very, very similar dynamics. And there are probably sort of two ways you can think about it, although, you know, I'm sort of speaking a little bit off the cuff, so I'm sure there's like some research out there that does a much better job than me. But from my perspective, I think there's two ways you can think about it. One is in terms of the institution itself. So you think about the hedge fund. You know, a hedge fund has a certain amount of collateral, capital, but what percentage of that is posted in margin? And so, and what's the volatility of that? And so you can think about the sort of the size of margin that they're posting, and obviously the assumption is that the size of the margin is, you know, supposed to be a good approximation of the risk versus how much capital they have. I mean, there are other ways of thinking, because obviously within a hedge fund, you would think quite a lot about correlation risk of all the different portfolio managers if you have a multi-manager fund. So you could think about like what the capital is that you have versus the amount of capital you allocate to all the individual PMs. And if you summed those instead of, you know, multiplying by them some correlation matrix, then, you know, how would that number look versus your capital? And then the other way of looking at it is which is kind of closer to what I was talking about today, which is what are the kind of potential liquidity drains. And so, you know, I talked a bit today about that for pension funds, this wasn't a solvency issue, it was a liquidity issue. And I think, and this goes a little bit back to sort of post-GFC regulations, I think there are quite a few risks that have been turned from, let's say, solvency or maybe credit risk into liquidity risk. And so now it's, you know, it's for everyone to take a look at the amount of liquidity risk that's out there, but also for the individuals involved to have really good kind of liquidity management processes, including kind of the operational and some of the sort of less exciting, but can you actually do what you think you can do in your kind of liquidity waterfall plan? And then that comes all the way down to, well, what are the sources of liquidity? We were talking before about, you know, so when I set out the sort of pension fund, I had the sort of 50 of other assets. but those assets were supposed to be kind of risky assets which generated your high performance. Well, if that's what you're relying on for your liquidity, well, that's going to be quite difficult to sell in a stress, and it's probably, you know, gone down a lot. So how much do you have of the kind of, you know, riskier end of the portfolio versus how much do you have in a money market fund that is cash-like and that you know you can draw on? And then there's questions, well, how much regulation should there be as a money market fund? Because if a money market fund is not able to deliver liquidity in a stress when it's needed, then, you know, all the plumbing starts to fail, and that's a little bit like we saw in Dash for Cash. So I've gone away from your original question, but, you know, you can sort of see how all these things sort of feed together. I've written down pension funds causing the. Let me take the last question. I'll try and remember exactly what the second one was. So I think your question goes to what I was saying before about the fact that, in a way, like, so there's a couple of points. Firstly, the LDI managers are often domiciled overseas. So when you talk about the regulations, yes, you know, there might be names that you know, the kind of insurance names, but the actual LDI funds are domiciled overseas. So that potentially is a bit of a problem, but the truth is that when we put out our recommendations, not only did TPR respond to them really well, but also, you know, the regulators in Dublin and Luxembourg, everyone's actually worked together really well at enhancing the resilience. So I don't want to, but just sort of in terms of a factual point. And so if you wanted to be positive, you would say that the LDI managers and the consultants together, they've provided a solution to a problem, and that's these really small pension funds that, you know, they do have the same kind of liability exposure which needs to be hedged as the bigger funds, but they just don't really have access to the product to hedge it. And, you know, so you can think about sort of two elements of the kind of LDI, pooled LDI offering. One element is that by gathering lots together, you kind of get the ability to do a hedge, which you couldn't do on your own. So it's just a sort of aggregation point. I think that's, if anything, a positive thing. You know, maybe it even reduces costs, it increases access. So that side of things are quite positive. But then there's the extra thing, which is, you know, they talk to these small pension funds and talk to them about their capabilities, and they say, well, we can solve that for you. We'll make it really easy. And even if you look through the documents, they've really structured it like an equity product. You know, it's an equity product. There might be a kind of fundraise. If you don't give your funds, you're diluted. It's like being an investor in a private equity. So they made it as easy as possible for the pension funds, and that sounds great. But what it does is it means that there's these sort of like tail risks, effectively, that haven't really been fully considered. And I think, you know, of course, I was talking about the pension fund trustees themselves, like having to think about this. But of course, the consultants, you know, and the providers, they need to make this very clear. And as you know, of course, like some of this, you know, now is in the headlines, but then was very much small print. And so exactly how this worked. So I think there is this sort of collective responsibility to ensure that, you know, they understand the sort of dynamic nature of these obligations. And frankly, it is true that for some pension funds, it's not the right product. You know, now then what do they do? You know, that's a different question. But you know, if you can't raise capital that quickly, you know, in kind of 13 days or preferably 5 days, then, you know, maybe it's not right for you.
Was it?
Yeah. So now, yeah, I've just remembered. So you said, was it just sort of the government or was it the pensions? And I think the way that we generally think about kind of financial stability risk is we think about shocks and we think about amplifiers. And so for the first order, the shock was external and the amplifier was this kind of structure that I've outlined. Now, and it's also the case that, for example, if you look at the FPC's reports in sort of summer of 22, we were worried about rising interest rates, and we said the kind of things. I think I had a quote at one point like, if we're worried if rates rise, then the vulnerabilities in the system will amplify shocks. And so that's a general comment about a number of different vulnerabilities, but it turns out that LDI was one of these vulnerabilities. We'd also done some work back in 2018 looking at the pension funds themselves and LDI, and thinking about kind of how resilient they were. But I think, so in a way it was kind of, it was known, but what was probably underestimated was, one, the size of the shock, two, the operational capabilities of some of these. So what looked nice on paper wasn't. And the third thing, which I think would be a fair comment, is that rates had been gently, or not even that gently, but had been rising in advance. And so the question is, were they at max resilience going into this? Well, no, because some of their kind of resilience had been. And so if they had been more actively recapitalizing in advance, then the amount they needed to raise, all of a sudden would have been less. So I think, I think it is right to say that there's probably a second order effect about kind of the specific resilience going into it. But first order, personally, I would still go with the kind of shock and amplifier model.
Okay, I noticed one or two people have already left us, but I'm happy to take another round of questions. I see Issam's raised his hand. And David. So Issam first.
Thank you for a very good presentation. Actually, I was wondering, how do you see the scope of interaction between monetary policy and financial policy? Naturally, you would think after so many years of low rates, people will drop toward leverage, and then as the fast tightening happens, things started to break. So I wonder whether you think that financial policymakers should have more of an input into monetary policy making.
Controversial, David.
Okay,
an easier one.
I was thinking of that question. An alternative question is, if, and as it's been happening on large scale, insurers buy pension funds, LDIs can be located in insurance companies or other non-insurance, non-bank financial institutions. Does the regulatory structure make sense when they change regulatory frameworks depending on where they're located, and the underlying assets, the underlying funds remain the same?
And one more, and then we'll call it quits at that point, I think.
So I was wondering, an extension to the first question, which is seemingly the low rate of interest is pushing people towards more riskier assets and products. To what extent do you see financial regulation evolving to tackle this? And should we be expecting more turbulent financial circumstances in the future as funds look towards more riskier assets to maintain their profits and things?
Great, Jon.
Okay, right, MPC versus FPC. So I think there's a couple of sort of angles I can talk about. One is it's very specifically about the intervention, and I think this is really important. And the truth was that the financial press picked up on it really, really quickly, and that was that obviously not that long before, the MPC had been buying gilts as QE, and then that stopped. They were starting to sell, and then the FPC kind of recommended, and the bank started buying. And so it would have been quite easy to say, well, hang on a minute, it's the same institution buying the same product, like it's the same thing, it's QE all over again. And I think it was extremely important for us to be very clear about differentiating between those two. And from a kind of mechanics of the purchases, there were some very, very clear differences, which we were extremely clear on, and the press picked up on really well, I think, which is it was temporary, it was targeted, Obviously, it was unwound, as quickly as possible. So those things were kind of about the mechanics of the purchase program. But for me, what's equally important is actually the very separate structure of the two committees, the Monetary Policy Committee and the Financial Policy Committee. They have separate mandates, they have separate kind of bodies, and the externals are very separate. I sit on the FPC, I'm solely focused on, the mandate that's been given to me and is by the government and is monitored by the Treasury Select Committee. And so the way I think about it, the most important thing was the buying was for financial stability reasons. It was motivated by financial stability reasons, by people who are thinking about financial stability. And, so that was the motivation and the mandate and the monitoring. And, to be clear, part of the monitoring of what we were doing and whether it was actually monetary policy kind of overreach was being done by the MPC, looking across, going, hang on a minute, like we've got a mandate here. So even internally, we're kind of making sure that there's a real sort of differentiation and clarity of purpose within the two. And I think it's very, very important. And the structure is quite different from some other jurisdictions. Obviously, there's the other committee, which is the PRC, which is more sort of on the micro side. So that's not quite the question you asked, but it sort of leads into the answer, which is that we do have extremely separate mandates. And, one way of thinking about it is, okay, the MPC, has a tool and there is a transmission mechanism from that tool, whether it's the Bank of England rate or bond purchases to the economy. And, they make some certain assumptions about how that transmission will work. But if there's financial instability, there is no transmission mechanism. And so part of our job is to make sure that kind of, moves, whether it's in credit supply and the kind of rates that are offered, are sort of warranted by the underlying monetary stance. And if they're unwarranted because they're driven by some other thing, some kind of instability, then that's a really bad thing, and that's our responsibility. And so once again, responsibilities are very, very separate. Now, if it were to be true that an extended period of some monetary policy setting were to build up risk somewhere else, then that is the FPC's responsibility to kind of look at those risks. So for example, we might have housing tools to make sure that, so in the time when rates were very, very low, we were ensuring that there were affordability tests such that if rates did go up, then people would be able to afford those. Now then, when rates did go up, of course, mortgages have become much less affordable, but there's less of a problem because of, kind of loan to value ratios and the stress tests than there otherwise would have been. So it's a sort of counterfactual benefit. So I do think that's right. Now, another way to think about it is we think about kind of business models that could potentially cause risks. And so that goes back to this kind of shocks and amplification business models. So leverage might be one, liquidity mismatch might be another. And so we kind of think, okay, well, in a rising interest rate environment, so that's your kind of scenario, you've got business models which might sort of amplify shocks. And then you've got your core markets, which are important for the transmission mechanism. And then you've got sort of other markets. And so you kind of think about a Venn diagram where those three meet, that's where your focus has to be as a FPC member. So that's a partial answer to the uncontroversial part of your question. LDI versus buyout. Yeah, I think that's a really interesting question. And obviously you're basically seeing a stick and a carrot, obviously, because of the changes in regulations of insurance at the moment. So there's three things. There's the shock that the trustees have just been through. Some of which, for everyone it was scary, no matter how it turned out. You've got the fact that for many, in aggregate, like funding levels are much higher. And you've got, sort of changing environment for insurers. So it would make sense, the incentive kind of like backdrop is there for a shift into buyouts. I mean, this is me speaking. I don't know, this is the bank. It's certainly not a sort of Bank of England sort of official policy on this, but I'm just sort of saying what you know already, which is the backdrop and the incentives are there. Like presumably, like the market will respond to that. I don't think I'm sort of competent enough to sort of go through all of the potential downsides of that. I mean, obviously, one upside is that it's like much more actively and professionally managed. So you're moving from a situation where trustees are meeting regularly, like you have to pull them back to look at this, to a situation where it's more professional. At the same time, of course, like pension fund regulation and insurance regulation is quite different. So taking a product from one to another does change things. Having said that, the buyout model, it's not like it's just been launched. There is a history of that. So it's more of a kind of shift, maybe acceleration of something that was already in place, rather than like suddenly this new and scary business model has like blossomed, kind of flourished in a way that would be very concerning. But really, I think in terms of the potential risk, that's a question for my PRC colleagues rather than myself. But I think it's a very important issue, and it certainly is something that will will be a topic going forward. So I'm not surprised you'll focus on that. Future. So so I think on the one hand you could say, well, actually, what's happened with rates, you kind of have this transition, very fast transition. And what I would say is that there are some business models that are potentially exposed to increasing rates, but there are many other business models that might be less exposed to the change in rate, but very exposed to the speed of the change. And so if you think about margin, think about VAR, these are all based on volatility, and volatility has shot up. So, and obviously we've been talking quite a lot about liquidity risk. Well, if volatility shoots up, then there's like a massive liquidity drain immediately. So there are these two issues which could to some extent be separated. One is the rise in rates, and the other is the speed in the move. So I guess that's one thing. So if you think about this as a transition from kind of one paradigm to another, then certainly some of the business models, whether it's due to liquidity mismatch, whether it's due to leverage and dealing with capital calls, might be exposed to that. You've also obviously seen in the US, sort of banks that are exposed. So there will be pockets of exposure to that. But then the question is, well, then when you're in the new regime, potentially you're actually thinking, well, if you were very worried about low rates like causing these problems, then actually the regime that we will end up in might be a better one. So you might have these sort of decrease in risk, the decrease in the need to sort of extend, either maturity or in credit risk or in kind of volatility space to sort of reach for yield. So I think it is, an interesting transition. On the flip side, you've got a lot of issuance coming. So the question is like, the demand for that and the liquidity side, as we discussed earlier. But I think, it's not, I think that, you have to separate level from speed, and you have to separate sort of transition from destination. But they're all interesting questions.